Good morning, Will. Lots to talk about then when it comes to Shell and the energy sector. Let's start with the numbers. The adjusted profit for the third quarter looks to be below estimates. That might not attract all of the headlines this morning, but what does that tell us about the business?
Yeah, I mean, there were a few headwinds. I mean, despite rising oil and gas prices, which are clearly a positive for the whole industry, and earnings were more than 4 times what they were a year ago. They weren't quite what investors expected. I mean, I think one of the reasons was the impact of Hurricane Ida, which had a big impact on Shell's operations and meant the production and refinery utilization was below what it was a year ago. And there were also some issues in the gas business. So it came in a bit below, but it's worth pointing out that cash flow, which was very strong and allowed them to reduce debt markedly.
OK, so that's interesting. So, you know, the oil price might be higher, but you've got to be operating maybe at full strength to take advantage of that. What about the CO2 reduction, the absolute emissions reduction target of 50% by 2030 versus the 2016 sort of benchmark? What do we make of that? I mean, the timing is, of course, because we're heading into COP26 and there's a lot of pressure on companies and countries to come forward with plans.
That's right. It's a departure for Shell because previous emissions targets had related to emissions intensity, i.e. how much carbon you produce for each unit of energy you produce. This is different. This is a commitment to actually reduce Scope 1 and 2 emissions by 50%, a big reduction. Scope 1 and 2, of course, relate to the emissions from Shell's own businesses, so it's refineries, it's trucks, it's drill bits. They do not relate to the fuel that it produces and then get burnt in aeroplanes and cars, etc. Yeah. What's going on here is that Shell lost a court case in The Hague earlier this year. A Dutch judge ruled that they had a duty to Dutch citizens to cut emissions because emissions were breaching human rights in Holland. Shell is saying we will meet the court's targets on Scope 1 or 2, hence the new target today, but they won't go as far as the court wanted on Scope 3. It also ties into the idea that investors are really looking, ESG-conscious investors really need to see progress from companies if they can stay in big oil. So it's also, on the one hand, it's trying to meet what the court mandated. On the other hand, it's trying to make the business ESG compatible. OK, and thinking about that, that's very topical because we have an activist investor, of course, taking a stake in Shell and trying to drive change, trying to spin off assets, which you could say is because of ESG concerns. You know, maybe if you spin out the renewables business, it attracts a higher valuation than if it's weighed down by other legacy assets. But that might not be the motivation here. It might be something else. What do we know about Dan Loeb and what he wants to achieve? Yeah, I mean, he wants to split the company in two. So he wants one company that has the oil business and just to sweat those assets for as much cash as possible and give that back to investors, just a cash-generative machine. And on the other hand, he wants a more ESG, environmentally friendly business consisting of Shell's gas business, its marketing business, its renewable businesses, which could appeal to an ESG-conscious investor. And in a way, you know, it's saying the current conglomeration of Shell can't serve two masters. It can't serve ESG, energy transition investors and the people who want returns from oil, so we should split it up. I think what Ben van Beurden will say later is that you need to keep it together and the cash flows from the existing oil and gas business are needed to finance the Shell of the future. And it's not a good idea to divide those cash flows, but it's a real bombshell Loeb's involvement, and it's going to spark an almighty debate about what the future of Shell is and what the future of big oil looks like. Yeah, the future of big oil, the future of these big energy businesses that have set themselves the targets of transitioning themselves. So rather than new businesses coming in to sort of eat their lunch, they've decided, well, we can actually do the gas, we can do the renewables, and that's what we've seen at Shell, we've seen it at BP, we've seen it at lots of these oil majors. And so if we see more of this in the future, that'll be really interesting. I mean, what kind of comment do we get from shareholders about their ability to invest in these big oil companies right now, Will? Because I did speak to one investor just fairly late earlier on, not a shareholder in Shell, but owns BP. He was saying, I don't think breaking these things up is necessarily the strategy forward. What do we hear from investors? But, you know, the problem that the industry has is that right now its share prices are really underperforming the oil price. We've seen this enormous rally in oil and gas prices, and that's been nowhere matched by how these companies are doing. There are a whole universe of investors who cannot invest in fossil fuels anymore. So there are real dilemmas there. And on the other hand, you've got investors, particularly in the US, saying, we don't want you to do the energy transition. We'll leave that to other companies. We want you just to make these companies produce as much cash as possible and give it back to us as dividends and shareholders. And you can see Shell trying to do both things. It's increasing shareholder returns. It's up to the dividend. Previously today, it gave a timetable for giving $7 billion back to investors from its Permian business divestment, which it agreed this year. But it's also trying to build a future-forward business. And I think the real argument here is, should companies be trying to do both of those things, or should they concentrate on one, or should they split those two ideas up?